Now, Morgan Stanley's former chief Asian economist says China's economic recovery is not sustainable and that stocks will likely fall further. Bloomberg Stephen Angle joins us with the details. Stephen, he's expecting, a further drop of 25%.
Yeah, that's what Andy Xie is saying. Right now, as we head into September, the market, a bit of a muted response after yesterday's nearly 7% fall. We're seeing the Shanghai Composite Index down, yes, again today for the fourth day in a row, but just down 1/3 of 1%. The Shenzhen Composite Index, the smaller market, down about 0.8%. And we're seeing, let's bring up the blue chips of the big cap stocks, PetroChina, ICBC, Sinopec, also Bank of China, China Life Insurance. These 5 stocks are the most heavily weighted stocks in this index, in the Shanghai Composite Index. 5 energy and financial stocks make up more than 1/3 of the entire Shanghai Composite Index weighting. And usually the direction these 5 go is the direction the index is going, but not so necessarily today. Most of the big caps are up, as you can see, even though the market is slightly down. Yeah, Andy Xie, he is the former Morgan Stanley chief Asian economist. He is now an independent economist. He says Chinese authorities are pulling the plug on what has been record lending so far this year to feed the government's stimulus measures in the first 7 or 8 months of the year. Xie says he just hopes it's not too late. Banks doling out more than 7.7 trillion yuan in new loans in the first 7 months of the year. That's 1.13 trillion US dollars, bigger than the annual GDP of Australia, I might add, nearly the entire economy of India. Banks lending through July already 60% higher than all of last year and more than double 2007 lending levels. The Shanghai Composite is officially in bear market territory, having fallen about 22% in August alone. The Shanghai Composite Index, as I said yesterday, falling 6.7%, the most since June of last year. More than 100 stocks fell by their daily 10% limit. These a little bit misleading because these are the stocks how they're trading today. At 2,600 points beginning today's trade, Andy Xie says the Shanghai Comp actually should be trading at about 2,000, which would be another 25% down.
I'm not sure this is the final bust. I think that it's a liquidity scare, and it's possible the market might recover a bit in September. But I think the market is still is in deep bubble territory.
Chinese ADRs overnight in New York fell for a 3rd day in a row, down 2.25%. But given the fact that the Shanghai Comp had more than doubled since last November's low through the year high we saw just a month ago on August 4th, some money managers welcome this market correction.
The markets generally were due for a correction, and China is probably the most obvious example, having been up nearly 80% year to date at one point. But you know, I think the cooling off we're seeing in China today and during this period, we would regard as a positive one. You know, many people have been wary of the massive lending amounts we've seen in China, perhaps ending in disaster. So I think the Chinese government is actually doing the right thing.
Goldman Sachs also remains upbeat on Chinese equities. The market's much cheaper, of course, than it was just a month ago, trading now at about 29 times earnings. And Goldman says Chinese stocks remain, quote, a bright spot among global stocks because of the nation's strong growth potential in China. Goldman saying that the market concerns about a near-term exit strategy appear premature as the government remains pro-growth. Remember, we are approaching the 60th anniversary of the founding of the People's Republic of China in just 1 month's time. And the last thing I think Hacienda authorities want on their hands is a bubble bursting in the market. Back over to you.